Welcome back to our channel. In this video, I'm going to explain and discuss and fill you in on the recent changes in the Canadian mortgage landscape, kind of that the government just shocked us all and made these announcements out of the blue. The Canadian mortgage space is always changing, so stay tuned and let's discuss everything in detail. Now, the first change that was announced is that insured mortgages are changing. So as of right now, when you get an insured mortgage, your purchase price has to be less than $1 million, just a penny less than $1 million, and you're able to obtain a mortgage with less than 20% down payment. Now, as of December 15th, you no longer need 20% down if you're purchasing up to 1.5 million. So basically, insured mortgages are going up, and you could actually purchase a property for up to $1.5 million with less than 20% down. Yes, you heard correctly. So previously, or actually right now, because the changes haven't come into effect yet, but right now, when you purchase a property up to $1.5 million, you need a $300,000 down payment. As of December 15th, your minimum down payment will be $125,000. Now, keep in mind your mortgage insurance premium will be quite hefty, and you will pay a lot of interest long term as well because of the additional mortgage insurance premium. But keep in mind, it will actually help many home buyers get into the market. Now, buying up to $1.5 million, we don't have specifics yet, but your mortgage insurance premium could be $50, $60, $70,000. That's huge. Now, remember, this is added on to your mortgage amount. It isn't paid upfront in cash. But I feel that this rule will be beneficial for applicants who are buying between $1 million to $1.2 million, because we do see a lot of applicants that have very high income. Now keep in mind, buying up to $1.5 million with less than 20% down, your total income required will be north of $300,000. It's quite a bit, most likely around $330,000 depending on what rate you receive. But many home buyers do want to buy for 1.1 million or 1.2 million because they just want to get to the next townhouse. They want to move to a different area, or maybe they want to move into a different area and buy a detached home so they could buy a basement suite. And getting from $1 million to $1.2 million is beneficial for them just because they don't have that 20% down. So for $1.2 million, instead of needing the previous 20% down, you just need 5% on the first 500,000, which is $25,000. And then from $500,000 up to 1.5, you need 10%. So when it comes to 1.2, 5 to 1.2, that's $700,000. 10% out of 70, 70 plus 25, a total of $95,000 is needed. Now, this is much more achievable for many home buyers because they have the high income and they do have $95,000. So I think it will benefit many people. Now, keep in mind, buying for $1.2 million, your mortgage insurance premium may be about $45,000. I know that's a lot of money. But keep in mind, if you're able to qualify for that home rather than renting, you'll save some money. For example, if you're paying, $2,000 a month in rent and you found out that your mortgage insurance premium is $45,000, well, if you keep renting to save up that 20% down to avoid that premium, and let's say you rent for 3 years, you will pay about $72,000 in rent. And at the same time, there's a good chance that the property that you could have bought that actually went up in value as well. So you're going to lose some market appreciation too. So overall, what I'm trying to say is do your cost analysis, run the numbers to see if it really makes sense to do any purchase, not just at $1.2 million, just any purchase, and weigh out the pros and cons because there's more to it when you run the numbers. Now, the second rule that was introduced or changed as of December 15th, first-time buyers can buy a pre-sale property or an existing built home, and if they're putting less than 20% down, they could obtain a 30-year amortization. Now, this basically allows buyers to qualify for more mortgage money because less income is required. So for a $600,000 property, if you put the minimum amount down, you actually need, as of December 15, $10,000 less income to qualify, and your mortgage payment actually goes down by about $300 a month. So you're able to purchase and your mortgage payment goes down. That's great news there. And also, if you're, let's say, a second-time buyer or a third-time buyer and you're buying a pre-sale, you could also get a 30-year amortization. I know that sounds a bit confusing, so let's clear it up. So always remember, when you put less than 20% down, you could only obtain a 25-year amortization. When you put greater than 20% down, so like 20% or more, you could get a 25 or 30-year amortization. Well, as of December 15th, if you're a first-time buyer, buying an existing built home and a newly built home, one or the other, you're able to put less than 20% down and obtain a 30-year amortization. So longer amortization means less income to qualify and less monthly payment. But if you're a second time buyer, for example, let's just say you own a property right now, you want to sell it and you want to buy a pre-sale and your down payment is less than 20%, you could also get a 30-year amortization. These rules were changed because before, only first time buyers were able to purchase a pre-sale or a newly built home and obtain a 30-year amortization. Now, if you're a first time buyer, you could buy any home less than 20% down and you could qualify for a 30-year amortization. So a couple of changes there as well. I know a 30-year amortization means that you will pay more interest long term. But again, you need to do a cost analysis to see how long you're going to live in the property for. Also, there's ways to offset the interest. For example, you can make lump sum payments against your mortgage principal to offset a lot of interest. And there are many strategies involved to offset the interest and lower the interest. Again, always a cost analysis has to be done. If you are thinking about renting for another 5-10 years, think about how much money you're going to pay in rent versus how much interest you're going to pay and plus your market appreciation. So that cost analysis has to be done as well. So two major changes there that were introduced that I feel like will help many people get into the market and get out of renting. Lastly, another change was introduced. So if you purchase a property and let's say you put a down payment of 20% or greater, you have an uninsured mortgage. Now, as of November 21st, if you're switching lenders, let's say you want to break your current mortgage, leave your lender, or your renewal is coming up and you want to leave your lender, and you originally bought with a 20% or greater down payment, which is uninsured mortgage, now when switching lenders, you no longer qualify or need to qualify under the stress test. So the stress test is always involved when you purchase a property. You always got to qualify under a certain stress test. And when you qualify under the stress test, that means you need more income to qualify for a certain loan amount. Now, when switching lenders, because before this policy was just for insured mortgages. So when you place a down payment of less than 20% insured mortgage, before the government said insured mortgage, if you bought a property and you have an insured mortgage and you're switching lenders and you're getting another insured mortgage, well, you no longer have to qualify for the stress test. Now they made it for any sort of mortgage, insured and uninsured. So as of November 21st, uninsured also qualifies as well. This is huge because this promotes competition amongst lenders. Lenders knew before that, you qualified under a stress test, rates went up, you're not going to leave us anymore because you're trapped and we have you. So therefore, we're not going to offer you the best rates and the best terms and the best mortgage products. Well, now we're in an environment where rates are going down and they know that clients could leave them. So this will promote competition and will promote them to give you a better mortgage rate, a better mortgage product, and just better terms and conditions. Because now at renewal, or even in between the term, rates are going down, you no longer have to qualify under the stress test. So lower income will be required. This is big also, and I feel like a lot of people are missing this key point. During an environment where rates are going down, many buyers will be able to switch their mortgage to a new lender. And this will mean that their mortgage payments will go down, especially buyers that bought over the last couple of years and locked in at a very high rate. This is going to help with cash flow. Many home buyers will see extra cash flow because their new rate comes into place and now their mortgage payment goes down by $100, $200, $300, $400, or even $500 a month. It all depends on how much of a mortgage amount you have. And at the same time, I feel like it will allow a lot of people to maybe think about buying an investment property. Because depending on where you are, let's say you're in the Vancouver area and you want to buy an investment property, you'll see that things don't really cash flow as much. And you may need to put extra money out of your pocket. $100, $200, $300, $400, $500 a month. Well, if your principal residence mortgage goes down by a certain amount, let's say $200 a month, and you find a certain investment property that needs an additional $200 a month inputted in from your own pocket, well, you could potentially make this change because you have that cash flow. And now, second of all, another major point is if you're switching lenders and your mortgage payment is going down, on paper, you will qualify for a larger mortgage amount for the second property. No one's talking about this, and this is huge. So right now, let's just say your mortgage payment is $3,000 a month, and then all of a sudden you switch lenders, and now your payment goes down because rates have gone down to $2,500 a month. Well, when you're applying or qualifying for the second property, the lender, the other lender, the new lender, will use a payment of $2,500 a month because that's your new mortgage payment. So that $500 a month will help you increase your mortgage qualification amount for the second property. Well, thanks for tuning in. I hope you enjoyed this video. I hope you now are very knowledgeable about the new mortgage rules and all the changes that came into place. And who knows, we might see more rules change next week because the federal government seems like they want to, promote real estate here in the Canadian landscape. And don't forget to like, share, subscribe, and get updated on our new most recent videos because anytime there's a change, we will do our best to update you right away.